Hello, my dear friends. So, I hope all of you are doing good, right? As you know, in our previous session, we have started with our topic called as ratio analysis, isn't it? So, we're discussing the ratios now. And once we complete the discussion on ratios, I've told you that we'll be start solving questions as well. So, let's continue with the discussion on ratios first, right? Let's try to even recall what we have discussed uh, till now in ratio analysis. Okay, so if you recall, first thing, I've told you that this topic can also be called as financial ratios, because the two variables which we take here are the financial variables, right? Then financial analysis, because we're going to analyze the performance of the company, of the business. So based on the financial statements, based on the financials, we are going to do that analysis. So that's why it's called as even financial analysis. It's judging the financial health of the company, correct? Analyzing the financial health of the company. Then we said it's also called as financial analysis and planning. Reason being, not just we analyze after calculating the ratios. Okay, after calculating the ratios, it's not just we analyze, but also we do some planning. That means take some remedial action as well, correct? Then we have said the objective of this topic is to make you what? To make you a financial doctor, correct? Then what is ratio? So we said it's a mathematical relationship between two related variables, two related figures, right? And which figures are we talking about here? The financial figures, right? That's ratio. So it's a comparison. It's a mathematical relationship between two variables. That's ratio. Ratio analysis, as you know, it's not just calculating ratios, but analyzing the financial performance with the tool called as ratios. How do we denote these ratios? So we said there are different ways, like percentage, fraction, or maybe is to number of times. These are some of the ways which we have said will be used. So now if I talk about like profitability ratio, generally you know that is denoted in percentages. When we talk about current ratio, right, or the liquid ratio, that is denoted in is to 2:1, 1:1, like that. So it depends upon how people use it. So we'll also use the same way, right? If we deviate, if we use a different way of denoting, then it becomes difficult for people to compare, correct? So that's where we also follow what generally people follow, we said. Then we said this topic is a process, because it's not just about calculation, but also about analysis and remedial action. That is how we said it will be different from the way you have read earlier in your 11th, 12th, and now the way you will be reading here, correct? Then I've also told you that there can be two types of comparison. One is absolute comparison, another one is relative comparison. Absolute comparison means just comparing the two figures, but relative comparison means comparing in relation to, correct? You compare that particular figure in relation to some other figure as well. Like we said, simply talking about net profit of two companies and saying, like in our example, we said company 2 is doing better because it is having a net profit of 10 crores. But the moment I give you the amount of sales, right, which is 3 crores and 100 crores respectively, that is of the two companies. So we get to know, oh, 1 crore net profit earned by a sales of 3 crores, whereas 10 crores net profit earned by a sales of what? 100 crores. So obviously you start seeing not just 1 crore, 10 crore, but you start seeing 1 crore in relation to 3 crores, correct? Same way 10 crores in relation to 100 crores. So then you understand actually you're doing relative comparison, right? And that is nothing but the ratio. So when we see that, we find that the company 1 has done better than company 2, isn't it? Then we said it's a toolbox where there are different tools, right? Ratios are nothing but a toolbox, and there are different types of tools here, like liquidity ratio, profitability ratio, turnover ratios, like that. There are different types of ratios involved here. Then is it that for every ratio we have some standard? We said no, it may not be, right? Some ratios may specify the upper limit, right? Some ratios we'll have to understand based on the situation. So it's not that every time we will have a standard ratio. Next, where will we get the inputs for calculating these ratios? So we said balance sheet, P&L, right? That's nothing but the financial statements. So that is where we were saying the knowledge of accounts is important here, right? The output of accounts can be input of the financial management, correct? Then talking about the different types of ratios, we said it can be classified on various bases. Like on the basis of statement, we may say balance sheet ratios. That means both the figures, both the variables are taken from balance sheet, like debt equity ratio, Then P&L ratio, both the figures are taken from the P&L, that is like gross profit ratio, that is gross profit by sales, so both comes from P&L. Then combined ratio, so we said maybe return on investment, so there you take return from P&L and investment or capital employed from where? The balance sheet. So this is how we understand combined ratios are also possible. So this classification is on the basis of what? Statement. Then on the basis of importance, we can say there can be primary ratios, there can be secondary ratios. Of course, primary means the main ones, secondary means the ancillary ones, right? The name itself suggests. So that way also on the basis of importance, we can divide the types of ratios. Then on the basis of functions, which is more popular, right? On the basis of functions is what people classify. Like in case of company, what is the basis, more popular basis? Membership. The moment you talk about type of company, you will say public company, private company, OPC. So that means basically we bother about companies on the basis of what? The membership. Same way here, on the basis of functions is what we try to classify the ratios into. So liquidity ratios, turnover ratio, profitability ratio, capital structure ratio, cash position ratios, we said these are the different types of ratios which we will find. So we will study on the basis of functions, correct? Then what is that we said we will be discussing when we discuss the ratios? We said we can discuss about the different names, the different variables, that is the two variables which we'll be using. Then standard or ideal ratio, right, or any upper limit there. Then who can be the users for that ratio? What is the formula? What is the meaning or importance of that ratio, right? How do we denote that ratio? What is the limitation of that ratio? Maybe we can take even example, isn't it? We can even talk about example, some examples also we can take. So this way we can discuss multiple things when we take up a ratio. Now you might ask, sir, what shall we write in the examination if they are asking us to write about a particular ratio? Seeing the weightage of the marks, you will have to decide. Okay, seeing the weightage of the marks, you will have to decide how much have to be written, and obviously you will use the important ones, right? You will pick the important ones and write them, right, based on the weightage of the marks. So that's not something which is difficult to answer. By now you are also having an idea, correct? Next, cash position ratios, right? We started with the types of ratios. We said on the basis of functions we'll be classifying the ratios. So the first one being cash position ratios, in which we said first one is absolute cash ratio. So if you remember, it's about what? Adequacy of the cash to pay off the current liabilities, right? Whether the company having sufficient cash to pay off current liabilities or not, that can be checked from absolute cash ratio. So here we have discussed first working capital cycle. If you can recall that working capital cycle, which is also called as cash to cash cycle, wherein I said cash or bank which is introduced is converted into raw material is converted into WIP is converted into finished goods then gets sold on credit, so debtors or bills receivable, which can then get collected, so it becomes cash. So this cycle is called as cash to cash cycle, and we said we'll be discussing this, right, in our working capital management topic as well. And then we said that this cycle has to move faster. That means the period, the time which is taken should be lesser and lesser. Lesser the time taken, that means more is the number of operating cycles, more is the number of these working capital cycles which is possible. And more the cycle, more the number of the cycles, you can say more is the efficient, right? More is the efficiency, more is the efficient management, more is the efficiency, right? Then, so we said, how do we calculate this? So cash plus marketable securities by current liability. So if you remember, I've told you what is marketable securities. Those are nothing but cash equivalents as per your AS3. So that is something which can be converted into cash easily without much loss of time and value, isn't it? So I've told you also that this particular marketable securities are dealt with in money market, right? Stock market, share market is different. Derivative market is about futures and options, that's also different. Debt market is also different, which is dealing in debentures, bonds. Money market are those, is that market wherein the marketable securities are there, right? Lending and borrowing for short term is there, like for 1 day to less than a year, that is 364 days. Treasury bills can be there, commercial papers can be there, call money can be there, right? Why the name call money? Because the lender can call the money at any time. Lender can call his money at any time. So that's where call money. This money market, right? You can put money for short term purpose. If you have let's say surplus money for just one day, okay, in your business you have just surplus money for just one day, still you can go for investment, because keeping the money in current account will not fetch you anything. But when you invest in money market, I've told you, you can get some decent return, maybe 6 to 7%, but then at least you're getting something, right? Something is better than nothing, right? And we said we'll be talking about these type of things when we go to sources of finance, right? Right, sir. So marketable security is nothing but cash equivalent, can be converted into cash whenever they want without much loss of time or value, correct? Right. Then we said higher the ratio, more will be the comfort. That means there is an adequacy to pay off those current liability, right? Enough cash is there, so it's good. Current liabilities we have discussed, I'll not again revise that. Then cash to total assets ratio, you know, as the name suggests, cash to total assets means proportion of cash in the total assets, and more the proportion of cash, that means what? More is the comfort, right? Cash rich companies, cash cows we say in share market language, we call them as cash cows, like Infosys, TCS and all comes under this category, where they have adequate amount of cash or more amount of cash. So more the cash, and cash meaning not just cash, physical cash, it can be in the form of marketable securities as well. So more will be the comfort. So when we talk about the proportion of cash in the total assets, that's nothing but cash to total assets ratio. And then we said, if you remember, not to forget, this ratio cannot be more than 1, or even equal to 1 is not possible, because you can't expect that the total assets are completely in cash form, right? That won't happen. Then cash interval. So here we said that cash which is there in the business is enough for how many days to meet the operating expenses, right? So that is where cash plus marketable securities divided by average daily cash operating expenditure, correct? Average daily. So on an average, how much is the daily cash operating expenditure? Cash operating expenditure means that operating expenditure for which cash has to be paid, cash outflow will be there, isn't it? So average daily cash operating expenditure. So this will help us understand that the cash which is there is available, is enough to meet 10 days daily operating expenditure, 15 days, 16 days, 20 days. So like that, higher the number, obviously higher the number of days or number of months or weeks, more will be the comfort, right? Instead of that daily, we can take monthly, weekly, as per our requirement, we can go for. So in all these three ratios, which are cash position ratios, we have seen that the numerator has got what? Cash plus marketable securities. Denominator is changing. In absolute cash ratio, denominator has got current liabilities. In cash to total assets ratio, total assets is there in the denominator. And then when it comes to cash interval, you know, average daily cash operating expenditure is there in denominator, but numerator in all these three remains the same, correct? Right. Then we have started with working capital ratios, which is also called as liquidity ratios, right? So in that, the first one which we have seen, or the one which we have seen, because we have to see the other one as well now. So the one which we have seen is current ratio, which is also called as short-term solvency ratio, right? Current ratio is also called as short-term solvency or working capital ratio, right? So this is calculated by way of current assets by current liabilities. Nothing but going to check the adequacy of current assets to pay off current liabilities, the adequacy of current assets to honor the current liabilities, isn't it? So standard ratio is 2:1. That means if 1 rupee current liabilities is there, then 2 rupees of current assets should be there, right? If it is there, then definitely they will be able to pay off current liabilities easily. That's the idea. Or I have told you also that you can interpret like this as well, that if there is some current current assets of 200 rupees, current assets of 200 rupees and 100 rupees is the current liability. So funding of those current assets, 200 rupees of current assets are there. So funding of those current assets have been done partly from current liabilities, partly from long-term liabilities, correct? So if 100 rupees have been used for from current liability, that means where did the balance 100 rupees come from? So we said obviously long-term funds. So that is how we could understand. And then we said this ratio, the standard may differ from industry to industry. Generally it is 2:1, which is advisable, right? Then if you remember, I have talked about like how we can group the balance sheet. So equity, share capital, preference, reserves and surplus, I said this is nothing but equity. Long-term debt, debentures and all, when we talk about that, is debt. This trade creditors, bills payable, provisions and all are current liabilities. Plant and machinery, land and buildings, furniture, fixtures is fixed assets. Stock, debtors, bills receivable, cash in hand, cash at bank, right, or marketable securities, this is current assets. So if you take current liabilities from liability side to asset side, right? If you're taking it from, if you're shifting from current liabilities from liability side to asset side, you'll have to subtract that. So when you subtract current assets minus subtract current liabilities from current assets, you arrive at working capital. You arrive at working capital, isn't it? Acha. Just in case I say there is some fictitious assets also. Okay, let's say there is some miscellaneous expenditure to the extent not written off, right? Some preliminary expenditure to the extent not written off. There are some accumulated losses. So you may find them in the asset side, isn't it? So if there are some fictitious assets, what will you do? Obviously, when there are fictitious assets, we'll have to take those fictitious assets. Okay, let me just write here. If let's say there is some fictitious assets on the asset side, then we will have to take those fictitious assets to the liability side and subtract it. From where? Reserves and surplus. So from asset side, if you're taking any figure to liability side, obviously you'll have to subtract. And these fictitious assets means assets for the namesake. So when there is an asset for the namesake, right, when you know there is something something called as P&L debit balance, there is accumulated loss, right, there is some preliminary expenditure not written off, you write it off from where? The profits, right, the reserves and surplus, right? So that's where we are going to deduct it from where? Reserves and surplus. So in short, we were saying the balance sheet looks like equity, right? Liability side equity, debt, and then asset side we have got fixed assets and working capital. So when we say working capital, that means we have taken care of current assets and current liabilities both, correct? So current assets minus current liabilities will give us working capital. Fictitious assets is anyways deducted from the reserves and surplus, so equity takes care of it, correct? So that way I have taken some example also, if you can recall, right? And we said this is the most popular ratio, right? Current ratio is the most popular ratio among the liquidity ratios. So this much we have discussed earlier, and now we have to continue with what? Liquid ratio, which is also called as quick ratio or acid test ratio. So let us continue with this ratio now. Okay, let us talk about this particular ratio, liquid ratio, quick ratio, or maybe called as what? Acid test ratio. Right. So how do we calculate liquid ratio? Right. The first thing, let's talk about the formula. Let's talk about how do we calculate this quick ratio. Okay, it's quick assets divided by quick liabilities, or maybe we can say liquid assets divided by liquid liabilities. Okay, quick assets divided by quick liabilities, or liquid assets divided by liquid liabilities, right? So first thing, if you recall the working capital cycle which we have discussed, I'm drawing it again, you may also draw it. Cash and bank, right? Cash and bank gets converted into raw material, which gets converted into WIP, which becomes finished goods. Finished goods gets sold, so it becomes debtors or bills receivable. From there it becomes again cash, right? So what are we trying to say, right? But when we talk about this quick ratio, when we talk about this liquid ratio, we're saying compare the liquid assets with liquid liabilities. That means adequacy of the liquid assets to pay off liquid liabilities. So obviously the question comes now, right? This is what? First thing, adequacy of current assets. Adequacy of current assets, no, quick assets. I've written directly in short, but please you make sure that you write first quick assets and then denote by QA, and then you can write always QA later. So adequacy of QA, that is quick assets, to pay off what? Quick liabilities. Adequacy of quick assets to pay off quick liability is nothing but quick ratio, right? And when we talk about now quick assets, what do we mean by that, right? What do we mean by quick assets? Is it the same as current assets? No. You might be knowing that quick asset is nothing but current assets minus the inventory, that is the stock, minus if at all there is some prepaid expenses, then we have to subtract that as well. Okay, So if you are able to understand, quick assets means nothing but cash. Okay, as you could see here, cash. Okay, nothing but cash. And if you understand, nothing but debtors. Nothing but what? Debtors or bills receivable. So what we are trying to say is something which is closer to cash or cash is nothing but quick assets. See, this particular raw material is far off from cash and bank, right? This particular WIP is far off from cash and bank. This finished goods also is far off from cash and bank. That means it will take time, more time for raw material, WIP or finished goods to get converted to cash, right? Cash, bank, marketable securities anyways is in cash form or can be easily converted into cash, and debtors or bills receivable is definitely what? Possible that you convert into cash, because you know there is something called as even bill discounting, right? You go to the bank and get the money, something like that, right? So factoring also is possible. We'll be reading about factoring as well, where you can give the right, you can assign the right of collecting money to someone else. So he may give you the money in advance and then he may collect it. So that means that is also easily possible to be converted into cash, right? But this inventory, this stock of raw material, stock of WIP, stock of finished goods, that is not a quick asset. Okay, that is not a quick asset. Same way, prepaid expense, you've paid some expense in advance, you'll get the benefit, but you cannot say that you'll get the cash. So that's why we are deducting that also from it. So one way of calculating quick asset is subtract from the current asset. Okay, subtract from the current asset the inventory and the prepaid expenses. Okay, right, sir. Or another possibility of calculating this is nothing but take the cash balance, take the bank balance, and obviously marketable securities, right? Take the debtors, take the bills receivable. If you take these items, you will get the quick assets. Okay, sir. So this is how quick assets. Okay, what is quick asset? Quickly converted into cash or is in cash form only. Okay, quickly, faster than the other items of current assets. Acha. So can I say all the quick assets are current asset, but every current asset is not quick asset? I repeat again. Is it that all the quick assets are current assets, but every current asset is not a quick asset? Yes, absolutely right. Every quick asset is current asset, but every current asset is not quick asset. It may take time, right? You know the definition of current asset, the asset which will take or which is there for 1 year or less than 1 year, correct? Which will give you the benefit for 1 year or less than 1 year. But then when we are talking about quick asset, quickly convert into cash. Okay, right, sir. Now let's talk about the other variable, right? We have discussed the other names for quick ratio, liquid ratio, acid test ratio. Secondly, we have discussed the formula. Now we are discussing, then we have talked about the meaning as well. This is adequacy of quick assets to pay off quick liabilities. Now we are into those two variables, because we are saying that in formula we'll take quick assets and quick liabilities. So obviously we should know those variables, and that's what we are talking about. Now, one way of calculating quick liabilities is subtract from the current liabilities, the bank overdraft, or you can say cash credit. Okay, subtract from the current liabilities what? Bank overdraft or the cash credit. Or other way of finding out quick liabilities is, you'll say, sir, trade creditors, maybe some expense creditors, correct? Or maybe some bills payable is there. Yes, that is nothing but quick liabilities, meaning you might have to pay them anytime, right? Current liabilities means it is repayable within a period of maximum 1 year. So less than 1 year or max to max 1 year, right? When we talk about quick liabilities, that means you might have to pay them anytime. So we are trying to check whether there are enough quick assets to pay off quick liabilities. If not all the current liabilities, at least quick liabilities. So the question comes now, is bank overdraft not a quick liability? Is cash credit not a quick liability? Is it that bank will wait for some time? Yes. See, when we have some current account, right? A business can have a current account with the bank, and you know, I mean, the businessman might have regular relationship with the banker. So to respect that relationship, sometimes when the business doesn't have sufficient balance in the current account, still the banker might honor the check which has been issued by that particular customer, that is the business, isn't it? It happens or not? We have discussed this in Negotiable Instrument Act also, if you remember. So in order to help the businessman, the banker might give a facility wherein they may say, even if you don't have sufficient balance in your account, still you may give a check, right? Or you may have some funds in your account, but you may give a check for more than that and we will honor it. So that sort of facility is being given. So now for this, do you think bank will collect something? Yes, bank will collect interest. So if let us say 10 lakhs is the balance, 10 lakhs is the balance there in the account, current account, but the check issued is for 12 lakhs. That means now if the bank is honoring this check, so the business, the company has overdrawn how much? 2 lakhs. 2 lakhs negative balance it will show. So for this negative balance, the bank will charge interest. Later on, let's say 5 lakhs deposit has been done. So the balance will turn out to be 3 lakhs positive. 2 lakhs negative was there, 5 lakhs deposit. So now the balance will become 3 lakhs negative, 3 lakhs positive, correct? Next. Then the question comes, sir, later on, let's say 6 lakhs cash is given, 6 lakhs check is given. So 3 lakhs only was the positive balance. So again, the balance will come out to 3 lakhs negative. Like that, it will happen. So whatever is the negative balance, for what time the negative balance was there, they will be charging interest. For positive balance, they never give interest. In current account, we am talking about. But for negative balance, there will be interest charged by the bank. That's the drawback, right? That's the drawback. Negative balance interest will be charged, but positive balance, interest will not be given. Okay, sir. So bank overdraft, anyways, we know earlier also we have discussed. Now, what is this cash credit? Cash credit meaning what? It's also nothing but a type of overdrawing facility, but there the limit is fixed. Because see, now I said sometime 2 lakh overdrawing, sometime 3 lakh. So again and again you have to request the banker and banker has to allow that. Instead of that, when you know regularly you are going to do this, you in the sense the business, the company, right? Always in our discussion, I've told you earlier only, we are talking about company, right? That to manufacturing company is what we mainly talk about. Okay, so when we are talking about this company, this business, which is regularly in need of funds, regularly they overdraw. So they can go for cash credit facility, wherein some limit will be set, and till that limit, no need to ask the banker again and again. Regularly don't have to request the banker again and again. Okay, don't need to request the banker again and again. That's the benefit of cash credit. So it's like this much amount anyways is credited to your account. We have credited. You want to use it anytime you can use it. Okay. But here what will happen is if they set like that, then if you don't withdraw that much of amount which they have set, the limit which has been set, then you might have to pay something called as commitment charges, because bank has said, okay, CC limit of 1 crore. Okay, bank has set some CC limit of 1 crore and the business has not utilized. They have not utilized anything out of that 1 crore. They could have overdrawn up to 1 crore, but they did not. So does it mean now they will be charging interest? No, banker will not charge interest because you have not used funds. But then banker will charge something called as commitment charges, because there is an opportunity cost for bank also. Banker has set aside some funds for you, and if you are not overdrawing, that will be a loss for them. So that way, in bank OD they will be charging interest, in CC also they will be charging interest, but in CC they can charge one more thing, which is commitment charges, or maybe they can call it by some other name also. Not necessary that they will be calling by the name commitment charges. It differs from bank to bank. Okay, so I hope you are able to follow that. Maybe in current account we can find that the banker gives the facility of what? Bank overdraft facility they may provide, right? They may provide the overdraft facility, or they may provide the cash credit facility. In overdraft facility, regularly as and when required, request the banker and overdraw the amount, right? Whereas in CC, don't have to request again and again. Once for all, some limit is set. Okay, if you want to change that, then you have to request again. Okay, so in this case of OD, they will be charging interest on the negative balance. Here also they will be charging interest, okay, for the amount which is overdrawn. Apart from this, I said in case of CC, they may collect something called as commitment charges. Because again and again that headache, regularly that headache is not there. They're keeping some amount for you, and if you don't use it, that's your problem. Correct? Right, sir. So what is bank OD, my dear friends? Bank OD means nothing but a facility provided by the bank to to the business, to the current account holder to overdraw his account. That means he can draw more than the account balance. For this, they will be charging interest. So they never ask for repayment. What they ask for is interest. They say, okay, their business is what? Lending, right? So they'll say, come on, take the money, keep paying us the installments, keep paying us the interest. So please understand, that is why they are not quick liabilities. Same way CC. That's also nothing but overdrawing, right? For that, you don't have to request regularly. You don't have to request again and again. Once the limit is set, up to that limit, you can draw whatever amount you want. And for that, obviously interest will be charged. Correct? Right. So in this case of bank OD and CC, what I'm trying to say is, it's not that the banker will be in a hurry to get the money. Banker will say, keep to the extent, keep to the, up to the time you want, but keep paying us interest. That's what is their business, lending of money. You'll say, sir, will they take any security for this, providing this bank overdraft and cash credit? Obviously, yes. They take security. Hypothecation of stock happens, right? You might have seen or you might have heard of that they take security to give this bank overdraft facility or cash credit. Understand? Without security, they will not give this facility. Right, sir. But if I talk about trade creditors, those suppliers, right, those who are supplying goods, raw material to the business, expense creditors, that means those outstanding expenses which are there, right, bills payable. So these are nothing but quick liabilities. You might have to pay any time. So that is where we are checking the adequacy of quick assets to pay off quick liabilities. Okay. Now you'll say, sir, what is the standard ratio here? Standard ratio is 1:1. That means what? If 100 is the quick liabilities, then 100 shall be the quick assets. Then they are in comfortable position, right? This is how they're saying standard ratio should be what? 2:1. Should be what? Should be 1:1. I'm sorry, not 2:1, but 1:1. Right. Now, one thing you'll have to understand here, that there is another school of thought. Okay, there are a few people say that instead of calculating quick ratio as quick assets upon quick liabilities, what we shall do is quick ratio shall be calculated as quick assets upon current liabilities. Quick assets upon what? Current liabilities. Acha, so instead of quick liabilities, they're saying take what? Yeah, current liability. Take all the liabilities. Why do you even forget, or why do you even ignore this, bank OD and CC also? They say take that also and check the adequacy. Acha, sir, for 1:2 formula. Yes, this is the limitation. There are few ratios where there are two formulae, there are two school of thoughts. That's one of the limitation you can say. So I repeat again, sometimes you may find two formulae, okay, two approaches for one ratio, I'm saying this is nothing but the limitation. This is nothing but the limitation. Of ratios. Okay, I repeat, what is quick ratio? Adequacy of quick assets to pay off quick liabilities. But then sometimes even people say take the adequacy of quick assets to pay off current liabilities. Don't ignore even bank OD and CC. Consider that as well and compare it with quick assets. Okay. Right, sir. So this was quick ratio. Okay, this was that liquid ratio. So what did we discuss here? Did we discuss the other names? Yes. We've talked about the formula. Yes. We've talked about the meaning. Yes. We've talked about the variables also. Then we've talked about the standard ratio, which is 1:1. Then we've talked about the limitation here. Acha, who will be using these type of ratios? Who can be the users of this particular liquidity ratio working capital? The trade creditors, you might say, the expense creditors, the bank which has provided short-term loan, the bank which is giving that OD or CC facility. They are the ones who are mainly going to use this particular ratio. Okay, see, from company's side, the finance manager will calculate all the ratios in order to check the performance, correct? In order to check the financial health of the company, they will be calculating all the ratios. But from stakeholders perspective, from outsiders perspective, if you understand, right? So we are saying that mainly the bank which has given the short-term loan, bank where you have your current account, that is has provided CC or OD facility, or maybe the expense creditors, the trade creditors. These are the ones who will be bothered from outsider's perspective. I'm saying who will be bothered about these liquidity ratios or working capital ratios. Okay, right. Now just if you just compare current ratio, what was it? Current assets upon current liabilities, correct? Current ratio was current assets upon current liabilities. What was quick ratio? Quick ratio is quick assets upon current liabilities. Also we can take, instead of taking quick assets by quick liabilities, correct? And if you recall, absolute cash ratio, there it was what? There it was cash plus marketable securities, cash plus marketable securities divided by current liabilities, isn't it? So if you just try to observe the similarity which we have in these three ratios, is that you could see current liabilities is there in the denominator in all these three ratios, all these three ratios. So what does this show? This shows that the current we are checking the adequacy of the current assets to pay off current liability, or checking the adequacy of the quick assets. That means here that is maybe in cash form, the quick assets is in cash form or can be converted into cash easily. So that we are comparing with current liabilities, or we are comparing directly with cash, right? Whether the adequacy of cash is there to pay off current liability. So first we are comparing that current assets with current liability. Next we are comparing that quick assets with current liabilities. Then we are comparing directly cash with current liabilities. So if you understand, right? If you understand here, what is happening is you are going more closer to cash, from current ratio to quick ratio to the absolute cash ratio. You are going closer to cash and trying to compare or trying to check the adequacy of that with the current liabilities, correct? Whether adequate current assets are there, whether adequate quick assets are there, whether adequate cash is there to pay off current liabilities is being checked, is what I can say, right? So maybe you can, if you call, I'll say comparison probably, right, sir. So we have understood this. Now let's go for the next one, right? So we have seen the liquidity ratio, the working capital ratio. Now let's talk about the third one. What is the third type of the ratios? Third type of ratios is structural ratios. Which one? Structural ratios, or you may also call it as capital structure ratios. We may also call it as what? Capital structure ratios. Right, sir. So now what is this capital structure ratios? If you understand, this focuses on long-term solvency position of the company. Unlike liquidity ratio or working capital ratio, where the focus was on short-term solvency position, right? Working capital ratio or the liquidity ratio focuses on short-term solvency, correct? I think I've written it. If not, I'll just write it. Yeah, I have not written it. Okay. So focuses on short-term solvency position. Okay, this liquidity ratios. And when we are talking about capital structure ratios, that means we are focusing on what? Long-term solvency position. Okay, right. Now, before we start off with this, let's understand the capital structure. As such, you know it. So when I talk about capital structure, that means composition of capital. We've got what? Debt and we've got equity. See, it's a simple thing. If you want to do business, right, where will you get the funds? I've told you earlier also, there are two possibilities. At the end of the day, two possibilities. From your own pocket, or maybe from outsiders, maybe from others. So when from own pocket, we say that is nothing but owner's fund, proprietor's funds, right, shareholders funds. And when we say from outsiders, that means you're talking about borrowed funds, nothing but debt, nothing but that long-term debt, correct? So we know this already. It's not that we don't know. And this particular capital which is now employed into the business. So employed into the business means what? With this capital, with this money which has been brought into the business, will be applied, will be used for the fixed assets, or maybe for the working capital, isn't it? So they're investing that money into the business. Maybe you say, sir, sometimes it so happens that the money which is brought in, the own funds, borrowed funds which is brought in is in excess, maybe having more money. Then what do? Then obviously we'll go for investment. Investment where? In some other business, right? I am repeating again, as I've discussed earlier, balance sheet, simple balance sheet I've talked about, which is equity, then debt, or let me write it fully. Equity, that is nothing but we're talking about the shareholders funds or the net worth, right? And then so equity, then debt. The equity means nothing but shareholders funds, proprietors funds, owners funds, net worth. All these are the names for equity only. If you want, I can write it, right? Or owners funds, shareholders funds, proprietors funds, or net worth. This all means one and the same. Okay. Then second item is debt, which is nothing but you can say borrowed funds, right? Long-term debt, that means it's or outsiders funds, or you can also say outsiders funds. Right, sir. So equity, debt, and then here on the asset side we'll say fixed assets, and then working capital, right, which is nothing but current assets minus current liability. So the difference of current assets and current liabilities gives us working capital, right? Yes, sir. So the sum of these two, owner equity and debt funds, is nothing but the capital employed, in short I can say CE, capital employed. And this is nothing but the investment where? In the business. Whose business? Obviously company's business, right? Obviously the company's business, investment in the business. Now the question comes, is capital employed always same as investment in the business? No, sir. Sometimes there is a possibility that we may get more amount. Who knows? If we take an example, let's say 100 rupees is equity, 160 rupees is debt, so total capital employed is 260, whereas the fixed assets is, let's say, 140, and 100 is the working capital. So in that case you'll say, sir, 240 is coming out to be the total. So that means 20 is the excess money which is there. So this excess might be invested somewhere else. Investment in what? In others business. This 240 is investment in own business, that is business of the company only. Okay, this is also possible. Normally people will say capital employed and investment is same, because when they say investment, what they're presuming is investment into the business. Okay, normally it may happen. Okay, so when we say capital employed is equals to nothing but investment, that means investment into business, and we are presuming there is no investment in others businesses. That means the amount brought in is exactly the same which was required to be invested in the business. I'm repeating what I'm saying. Normally we'll presume that capital employed is exactly the same as investment in the business. That means the amount which is brought in by owners or the outsiders is exactly to that extent that is required into the business. But just in case you say, sir, there is some surplus, there is some excess, and they don't have the requirement in the business, then obviously they'll not keep it idle, but they will invest somewhere else. Okay, so that's where I said investment in others business. That is where it will become non-operating. So we will derive non-operating income. We may have non-operating expense as well. So if they specify that, then it will come. Otherwise we presume there is only what? Investment in own business, and income also only operating income, expense also operating expense. This is how it goes. Understand all of you? Right, sir. Now so we have followed this, we have understood this earlier also, we have talked about. So can I write here capital employed is equals to equity plus debt? Yes sir, we can write. Or we may say it can be fixed assets plus working capital, assuming that there is no investment in others business, correct? So capital employed is equals to investment in the business. Whose business? Own business. This is what I can say generally happens, if not always, and that's what is our presumption, right guys? What are the other names for equity? Owners fund, shareholders funds, proprietors funds, or maybe net worth. Okay, it's all one and the same. Equity, but it will have even preference share capital. Equity I said, but it still have what? Preference share capital, right? How do we arrive at owners funds net worth, right? If you want, I'll write that again. Okay, you can also write. How do you think we will get this equity, or as you know, net worth? Equity share capital. What is this ESC? Equity share capital plus preference share capital plus preference share capital plus reserves and surplus minus fictitious assets, if at all that is there, right? You would have written that in asset side, but ideally that should have been subtracted from reserves and surplus. That's where I'm bringing it here and saying subtract fictitious assets from reserves and surplus. This is what is equity or net worth, okay? Or proprietors funds or owners fund. It can be called by different names, or shareholders funds as well, right? Shareholders funds, owners funds, proprietor funds, right? Net worth, it's all one and the same. Then coming to debt. Debt means what? Long-term debt, borrowed, unsecured loan, secured loan for long-term purpose. It can have debentures as well. So if you want, I can write that as well. Debt, meaning you're talking about debentures, correct? We're talking about long-term loan. Oh. Long-term loan may be secured, may be unsecured, correct? Like that, maybe we can have some debt here. Right, sir. So while discussing capital structure, it is very important to understand the structure, the composition of capital. That's where I've just again gone into it, and maybe sort of revision we have done, correct? Now let's get into the ratios. In this capital structure ratios, let's talk about the different types of ratios. So my dear friends, now the first ratio, right? First ratio is equity ratio. What is the first ratio? Equity ratio. What is it? Nothing but the proportion of equity in the capital employed. What did I say? What is this equity ratio? Proportion of equity, meaning shareholders funds in capital employed. Acha sir, so that means we are saying this is nothing but equity divided by capital employed. Yes, definitely, that's what we're talking about. Proportion of equity or the shareholders funds in the capital employed. So we're talking about equity divided by capital employed. Now please tell me, if we have more and more equity in the capital employed, if we have more and more equity in the capital employed, is it going to be good or is it going to be bad? Is it going to create more burden, or is it going to be creating less burden? So the obvious answer here would be that, sir, more and more equity, more and more the higher the ratio it is, then it's going to create lesser burden, lesser risk, correct? So I'll write here, higher the ratio, that means higher is the proportion, higher the ratio, that is higher is the proportion of equity in the capital employed, implies lower the risk, correct? The risk is lower. and implies comfort will be more. Comfort will be more, burden will be lesser. Correct? Yes, sir. So this was the first ratio. Simple one, equity ratio. That means proportion of equity in the capital employed. Higher the proportion of equity, right? Higher is the proportion of shareholders' funds in the capital employed, lesser will be the risk. Correct? Right, sir. Sir, connected to this, obviously, we'll talk about debt ratio, right? Debt ratio, which is also called as debt to value ratio, which is also called as what? Debt to total value, or maybe you can say debt to value ratio, not total value, but debt to value we say. Debt to value ratio, which means what? Obviously, proportion of debt funds in capital employed. Okay, so how do we calculate this? Obviously, debt divided by capital employed. Debt divided by capital employed. This is how we calculate it. Now tell me, higher the ratio, please answer. Higher the ratio will imply what? Higher the risk, right? Implies what? Higher the dependence, higher the dependence on outsiders, isn't it? So kindly understand, if more and more debt is used, the risk also will increase. We have discussed earlier as well. But then we'll have to increase the debt to such an extent that the risk is also minimized and the cost is also minimized, so that we can meet the objective of financing, reduce the cost, right? Minimize the cost, overall cost, weighted average cost of capital, and minimize the risk as well. So use debt, but to just that extent which will not create more and more burden. That is where the challenge for finance manager I've told you. Correct? The job is not that easy. It will definitely require some skills. So higher the ratio here, risk will be higher, and that means the dependence on outsiders will be higher. Right, sir. So this was debt ratio, which is also called as debt to value ratio. So first one we have seen is what? First one which we have seen is equity ratio, right? Equity ratio. And now second one which we have talked about is debt to value ratio or debt ratio, isn't it? Oh. Now the third one which we are talking about is obviously a comparison between debt and equity. So the third one which we are seeing here is debt equity ratio. Which one? Debt equity ratio. So what is this? Obviously this is proportion of debt and equity, comparing not just debt with total capital employed or equity with total capital employed, but comparing what? Debt with equity. So that's debt equity ratio. All of us know this, right? How do we calculate this? This is calculated by way of debt divided by equity. That means debt and the owner's funds are being compared here. Do we know something more here? Yes, sir. We know the upper limit. The upper limit for this ratio is what? Is 2:1. Meaning what? If someone wants to have a debt of, let's say, rupees 200, right? He wants to have a debt of 200. So he goes to a bank and says, please invest 200 rupees, give us a debt of 200 rupees. They'll say, how much did you invest? At least you should have invested 100. Then there's a possibility they might give you a debt of 200. Or who knows, they may say, no, we'll not give you 200, we'll give you 180, we'll give you 160. So that means it depends upon financial creditor as well. Right? Financial creditor means what? The person who's giving you funds. Trade creditor means who's giving you goods or material, isn't it? So please understand, upper limit is 2:1, which may differ from lender to lender. That is financial creditor to financial creditor. Okay. Yes, sir. So we've understood this as well. Now tell me, if higher is this ratio, same way we'll go for, like we have gone earlier, higher the ratio, higher the ratio implies what? See, debt is in the numerator, so obviously higher the ratio means debt is more. So if debt is more, risk is more. Risk is more, that means the dependence on the outsiders, dependence on the outsider is also higher, is also higher. Followed, no? So kindly understand, when we talk about current ratio, okay, when we are talking about current ratio, we are talking about current assets and current liabilities, correct? This is nothing but short term solvency. And when we talk about this debt equity ratio, when we talk about debt equity ratio, please understand we are talking about debt and equity. So when we talk about debt and equity, that means we are talking about long term solvency ratio, right? We are checking the long term solvency position of the company by way of debt and equity, whereas short term solvency position by way of current ratio, isn't it? And if you note here, that, see, the current liabilities is in the denominator. Current liability is a liability which is in denominator. And if you just observe here in debt equity ratio, debt, which is a liability, is in numerator. When we are talking about short term solvency, we say current ratio, wherein current assets upon current liabilities we take. Whereas when we talk about debt equity ratio, there we take debt, which is the liability, into the numerator. So now, please tell me, when we say debt equity ratio, debt is in the numerator, higher the better or lower the better? Obviously, you'll say, sir, lower the better. Higher is not better here, correct? In this case. And when I'm talking about short term solvency, where we said current liabilities is in the denominator, so that is liabilities in the denominator, so we'll say higher the better, because assets are there in the numerator, so higher the better. Am I right? Assets are there in the numerator, so obviously higher the better. Whereas in debt equity ratio, debt is in the numerator, liability is in the numerator, so lower will be the better. That's what I just wanted to compare. Okay, right, sir. So we have understood debt equity ratio. Anyways, we had an idea as well about debt equity ratio. Now please tell me, who will be the user of this debt equity ratio? Sir, shareholders might compare this. Sir, banks which are giving long term loan, the debenture holders, right, who will be giving money for 5 years, 7 years, like 10 years, and also they might be also bothered about this debt equity ratio. Yes. So mainly we can say financial creditors or the owners, the proprietors, they will be bothered about this debt equity ratio, because this is going to decide the long term solvency position, right? Right, sir. Now let's go for the fourth ratio in this particular function. Fourth one. What is the fourth one? Capital gearing ratio. Okay, capital gearing ratio. In short, I will call it as CGR. Okay, I'm calling it as what? CGR, capital gearing ratio. This is actually, I can say, a modified form of debt equity ratio. Debt equity ratio. Right, sir. So what is happening here? Why this is called as gearing ratio? You might have this type of question. So please understand. See, debt equity ratio, when you take debt equity ratio, you take debt in the numerator and equity in the denominator. Right. When you talk about debt, that means you're talking about long term loan. You're talking about debentures, isn't it? Long term loan, you'll have to pay some interest. Same way, debentures, you'll have to pay some interest. So some interest is paid irrespective of profits, right? That means there is a fixed cost involved when it comes to long term loan and debentures. correct? Now when I am talking about equity, we have equity shareholders funds, correct? That is equity share capital, then preference share capital, right? Equity we are talking about. So equity means even going to include preference share capital, plus you will say, sir, some reserves and surplus, minus fictitious assets, that's okay. So what I'm trying to say is here, if you just note, the numerator has got those type of funds which are having a fixed cost, and if you just observe the denominator, equity shareholders will get dividend but only when there are profits, and that too it's not sure whether they'll get it or not. It's only when the board of directors decide to recommend, right, that is where there is a possibility that they might get dividend. But when I talk about preference shareholders, do you think preference shareholders will for sure get a dividend? Yes, sir. If there are profits, there should be profits. Dividend means appropriation of profits. Don't forget that. So if there are profits, they'll have to compulsorily give dividend to preference shareholders. That's where already the rate of preference dividend is also mentioned. At the time of issue only they decide what should be the rate of preference dividend. So in a way, if you understand, this particular preference share capital which is there is nothing but the funds which is involving fixed cost, because the rate is fixed, you know, beforehand itself that every year you'll have to pay some preference dividend if there are profits. So kindly understand, we are going to take this, we are going to deem this preference share capital also as what? The funds involving fixed cost. It's actually like that, no? Maybe that particular dividend has to be paid only when there are profits, that's for sure. But then compulsorily they'll have to give. Whereas equity, compulsory they don't have to give. So those financial creditors have to be given compulsorily some return. Same way preference shareholders have to be given compulsorily that return, but equity shareholders not. So that is how what has happened is capital gearing ratio has come. So what do we have in numerator in capital gearing ratio? Funds involving fixed cost. Funds involving what? Fixed cost is there in the numerator. And so, sir, what is there in the denominator? Funds involving variable cost. Funds involving variable cost. Okay. So the other way of writing this is long term loan plus debentures plus preference share capital divided by equity share capital plus reserves and surplus. And just in case you say, sir, fictitious assets are also there, then that will be minus fictitious assets. Okay, are you getting it? Okay, so this is capital gearing ratio, I said. So question comes now, sir, why is it that it is called as gearing? Why is it called as gearing? Is there any reason behind this? Yes, I will discuss about that, but let us discuss something called as trading on equity. Okay, let's discuss something called as trading on equity. So, sir, what is it? Yeah, I'm telling you. Trading on equity means use more and more debt funds, use more and more outsiders funds. That means use lesser equity shareholders funds and give them more returns. Sir, what did you say? See, take more from the outsiders and generate more and more returns for the equity shareholders. That's trading on equity. That means you're doing trading with the borrowed funds and generating more returns for the equity shareholders. Sir, this means we are taking a higher risk because we are going for more debt. Yes. So the fundamental idea, right, of trading on equity is what? Higher the risk, higher the return. Higher the return. Higher the return for whom? Higher the return for equity shareholders. Higher the return for equity shareholders. Okay. So what is happening here? I repeat again. What is this trading on equity? As we said, take more debt, take more of debt and generate more returns. Generate more returns for equity shareholders. Okay. But this is quite risky because higher the risk, higher the return. And see, if it is successful, they have taken, suppose there is a business opportunity and they've, instead of taking from equity shareholders, they've taken from outsiders, they've taken a loan, they've taken a debt, and the opportunity where, I mean, there was an opportunity, I said, so they invest in that opportunity and they generate good returns. So they'll pay off some cost to those debt providers, and the remaining one which is there is for whom? Equity shareholders. But just in case if that opportunity doesn't give them a chance to earn, right, doesn't fetch return as expected, then what will happen in that scenario? The equity shareholders funds might be used to pay off that debt. So that's risky as well. Okay, what did I say? Let us say there is some business opportunity. Okay, 100 crores is required, so they take it from the financial creditors, and they've agreed for, let's say they've taken a debt at the rate of 10%, and they were expecting that the business opportunity which is there will fetch 18% return. Okay, and it fetched. Okay, they could earn 18%. Okay, so earnings which they had was 18%. So net 8% is for whom? Net 8% is for equity shareholders. So without equity shareholders investing more, they could generate returns for equity shareholders. Without taking funds, more and more funds from equity shareholders, they could generate returns for equity shareholders. That's called as trading on equity. But the point is very, very simple here, which I said that now as expected they could earn 18%, well and good. But suppose they expected 18% but they could not earn anything, or they could earn only 2%, then what will happen? There will be a negative 8%, there will be a negative 10%. That means they will have to pay from their pocket. So this is how it is risky. So that's where please understand why the name gearing. It is the top gear. Now you drive a vehicle also at top gear. Slight top gear means top speed. Slightest what do you say, ignorance there, or slightest what do you say, diversion there, what will happen? You'll meet with an accident. Correct? So you'll have to be very careful. Same way here also. When we talk about this trading on equity, where you're going for what? You're going for more and more debt. That means you're going at top speed. So top speed, top risk, slightest variation there, then total evaporation of the money. So that is how, when we discuss this capital gearing ratio, we have to talk about even what is it, trading on equity. So kindly understand, my dear friends, why this capital gearing, right? Changing the gear. So instead of funds involving variable cost, you go for more of funds involving fixed cost, so that you can generate more and more returns for those funds involving fixed variable cost, that is nothing but the equity shareholders. But if it is successful, then good enough. If it is not successful, then it will lead to depletion of the funds of the shareholders only, because the shareholders funds might be utilized to pay off those particular financial creditors. So that's quite risky, isn't it? So this is how it is. Now I can say CGR is calculated for whom? For equity shareholders. For equity shareholders, to check how much is the gearing, right? Okay, sir. Acha. So now who will be the user of this? Equity shareholder. So equity shareholder will calculate and see, and if he has a lower risk appetite, then he will invest in those particular companies where the capital gearing ratio is low. But if he is having a higher risk appetite, then he will invest in those particular companies where the capital gearing ratio is higher. Correct? So please understand, capital gearing ratio is calculated for equity shareholders, and if risk appetite is lower, then if risk appetite is lower, then go for companies with lower capital gearing ratio. However, if you say the risk appetite is higher, then can go for companies with higher capital gearing ratio. So we cannot say that always go for lower capital gearing ratio. because if he's having a higher risk appetite, he can go for a company with a higher capital gearing ratio also, isn't it? So based on the investor's risk appetite, he'll have to decide which company to invest in, okay, with a lower one or with a higher one, right? Okay, acha. I could recall some examples. So if I just talk about some example here, it happened in case of Tata Steel. If you've heard of Tata Steels, some time back has acquired Chorus Steels. Chorus Steel. Chorus Steel was a bigger company than Tata Steel. So small fish eating the bigger fish. That was what happened. So when Tata Steel wanted to acquire Chorus, that was some around $2 billion deal. Okay, Tata Steel wanted to acquire which company? Chorus Steel. If you want, you can read also, you can Google and find out more details about it. This deal was, Tata Steel wanted to acquire this Chorus, and the deal was around some US dollar 2 billion. Okay, $2 billion was the deal. So out of this $2 billion, $1 billion was out of the borrowed funds. Tata Steel took what? Some loan from SBI and its constituents. They have taken around $1 billion US dollars loan they have taken. So just understand, instead of putting total shareholders funds, they've taken borrowed funds and wanted to generate more and more returns for whom? The equity shareholders. And they did this because they thought this will help, this particular collaboration will help in scaling up the operations, in going that in taking that Tata Steel brand as a global brand. That was the idea behind doing that acquisition. Okay, however, what happened was it was unsuccessful. So when it was unsuccessful, obviously when they had to pay to those particular financial creditors or lenders, they were finding it tough, and they had to use the shareholders funds to pay off that. So this is how maybe it can be costlier also. If it doesn't work out, if it doesn't go as expected, then it is like a huge risk for the company. Understand? So trading on equity, I'm saying again in short, trading on equity means what? Take more of debt and earn more for the equity shareholders. That's trading on equity. So that means you're going for higher risk. Higher the risk, higher the return. But this can be ulta as well. Higher the return might be higher the negative return. Who knows? Okay. So why did we discuss this? Because of capital gearing ratio. Because in capital gearing ratio, we are talking about what? The comparison of those funds which are having a fixed cost with funds which are having a variable cost. So you have to be careful in going for more and more debts with fixed cost, because if you are unable to pay them, unable to service them, unable to honor them, it will be quite risky, right? It will be a very great burden. So that's where decide whether you want to go into the top gear properly. If you think you can handle it, right? If you think you can go for the top speed, top gear, because you can handle it, you will not lose your attention there, your focus, your concentration will be fully there, you will not lose out. Go for it. No, then better don't. Understand? Right, sir. Right, now let's go for the fifth one. Right, we have seen the four. First one we have seen equity ratio, second one we have seen debt ratio, which is also called as debt to value ratio. Then we have seen debt equity ratio. Then we have also talked about capital gearing ratio. Right, now we'll go for the next one, fifth one. Okay, fifth one, what is that? Fixed assets to long-term funds ratio. Fixed assets to long-term funds ratio. Sir, the name says it all, right? You might say, sir, the name says it all. What is it? Fixed assets to long-term funds. So obviously fixed assets in the numerator and long-term funds in the denominator. So this is helping us understand how much of the long-term funds have been used for acquiring fixed assets, isn't it? Or you can say indirectly, this helps us understand that how much of the long-term funds have been used for working capital. correct? So what I'm saying is the long-term funds have been used for two things, right? I've told you earlier also. Balance sheet, imagine balance sheet, equity, debt, fixed assets, working capital. So this debt and equity is long-term funds. These long-term funds will be utilized for what? Fixed assets, or will be utilized for what? Working capital. So when we say fixed assets compared with long-term funds, that means we are understanding that how much of the long-term funds have been used for fixed assets. So in a way, this is complementary to what? Working capital to long-term funds ratio. If I know 60% is this ratio, that means how much is working capital to long-term funds ratio? 40%. Correct? See guys, this is the balance sheet. Okay, this is debt, this is equity, which is nothing but the capital employed. That means this is nothing but long-term funds. This will be applied for fixed assets or working capital. So first we are comparing this fixed assets with long-term funds. Next I'm saying we can compare working capital with long-term funds. So if you know fixed assets with long-term funds is 60%, that means working capital to long-term funds ratio will be what? 40%. Right? Great. And I hope by now you might have understood why we are taking working capital. Working capital when we are taking, that means we are subtracting current liabilities from current assets. That means that portion of current assets which is funded from current liabilities is anyways out of this balance sheet here. What is left is that amount of current assets, those net current assets which are funded from long-term funds. Guys, I'm repeating again. If I say current ratio is, let's say, 200 by 120, that means current assets worth 120 has been funded from current liabilities. How about the remaining 80 rupees worth of current assets? Where is that they have funded? Where is that they have funded from? So we'll say, sir, long-term funds. Correct? If current assets, this is current assets, this is current liability. So funding of current assets to the extent of 120 has been from current liability. So what about the remaining amount of 80? Remaining assets worth, current assets worth 80, that has been funded from long-term funds. Okay? Yeah. So that 80, the difference, working capital is nothing but the difference of current assets and current liability, that means 80. So this 80 is nothing but that current asset which has been funded from long-term funds, right? Right, sir. So I can say this ratio, right? This ratio is complementary. This ratio is complementary to working capital to long-term funds ratio. Then, as I said, this is helping us understand what? How much of the long-term funds have been used, how much of the long-term funds have been used for fixed assets. Correct? Acha, I have told you the other day, if you remember, whenever we have some long-term funds that can be used for long-term purpose or short-term purpose. But if we have some short-term funds, that should be used only for short-term. You can't expect that with current liabilities you'll acquire fixed assets. Am I right? The simple example I'll give you. Suppose I have taken some loan, okay? Taken some loan from whom? From anyone. Let's take example of Himanshu. I've taken loan from Himanshu. Worth how much? 2 crores. And I said I'll return you within a week. Now tell me, if I have taken this loan for repayment within a week, that means it's short-term liability. And with this 2 crores, if I go and buy some land, will I be able to repay that particular loan within a week? No, it won't be possible. But if I acquire some inventory out of that 2 crores, do you think there is a possibility that I might be able to repay that within the next week? Yes, it's possible. Correct? Right. Suppose I change this example and I say I take this 2 crore from Himanshu and I say I'll repay after, let's say, 4 years, 5 years. Now, can I invest this in land? You'll say yes sir, no problem, because you have to pay after 4 years, 5 years you said. Or if I want to invest in inventory, if I want to invest in business, can I do that? Yes, that's also possible. So guys, please understand, when you take long term funds, it can be used for long term or short term, anything. But when you take short term funds, you have to be careful that you use it only for short term. If you put it in long term, repayment will be difficult. Okay, right, sir. So we've understood this. Acha, please tell me, if I give you an example, let's say I take an example, 100 is fixed assets and let's say 180 is long term funds. Is it good or bad? Yes, sir, it is good. Is it possible if I say 200 is fixed assets and 180 is long term funds? Is this good? You'll say no, sir. So can I say this ratio should always be less than 1? Is it that it should be less than 1? Yes, sir. If it is more than 1, it is risky, right? So please understand, less than 1 is always better. Less than 1 is always better. That's what we can say. Okay, so we have understood fixed assets to long term funds ratio. That's nothing but how much of the fixed assets have been funded, or you can say how much of the long term funds have been used for acquiring fixed assets. This is complementary to working capital to long term funds ratio, right? How do we calculate it? So we said fixed assets by long term funds. Then we said less than 1 is always better here, isn't it? So now let's go for the next ratio, sixth one. I hope you're able to follow. We have discussed quick ratio today. Then after that we started with the structural ratios. And in structural ratios, we have talked about what? We've talked about equity ratio, debt equity ratio, capital gearing ratio, fixed assets to the long term funds ratio, and now we're talking about proprietary ratio. Okay, proprietary ratio. Now in this proprietary ratio, what do? We compare the fixed assets with the proprietor funds. Okay, or there is another formula, proprietors funds by total assets. Meaning what? How much of the proprietors funds have been used for fixed assets, or you can say how much of the proprietors funds have been used for total assets. Understand? Two formula are there. That means this is again a limitation, as we have discussed earlier also. One ratio but two formulae. So few people uses this approach wherein they take fixed assets upon proprietors funds, and few people are there who take proprietors funds by total assets. Okay. So now tell me, if I take an example, fixed assets is 100 and proprietor funds is 80. What does this mean? Fixed assets is 100 and proprietor funds is 80. What does this mean? Fixed assets worth 20 has been funded from debt funds, has been funded from borrowed funds. This is what we can understand, right? Acha. Suppose I say 80 is proprietors funds and total assets means what? Total assets means fixed assets and current assets. So let's say the total assets is 140. That means fixed assets and the current assets are worth 140. Funding of that has been done by proprietors funds to the tune of 80. This is what it is indicating. So proprietary ratio means you want to know where did the proprietor funds go, in the fixed assets, in the total assets, right? It might go in the fixed assets or in the fixed assets and current assets both, right? So when we say take fixed assets by proprietary funds, that means you're saying check the funding done towards fixed assets. But when you say total asset, that means you're going in a combination there and trying to understand how much of proprietors funds have been used for the total assets. Now obviously the question will come that, sir, if 140 is the total assets and 80 is the proprietary funds, then how about the 60? How about the remaining 60? Remaining 60 total assets, where did they get from? Obviously debt funds, borrowed funds. This is what we can understand. So if you know this proprietary ratio, then obviously you can know how much of the debt funds have been used. Correct? So when we talk about this, do you think more and more proprietary funds should be there? Yes, sir. Because if you take more and more debt, then more and more risk. That's what we know. Right. Acha, just a simple clue. so that you remember in the numerator fixed assets is there and denominator proprietary funds. Same way, proprietary funds in the denominator, no, it's ulta here. So I'm just giving you the clue. Fixed assets means start with F, proprietary funds means start with P, total assets means start with T, right? Ultimately these three are there in these two formulae. So when I'm taking alphabets, you know, first F comes, then comes P, then comes T. So when you have to take fixed assets and proprietary funds, first fixed assets, that means in the numerator, and then denominator proprietary funds. But when you are taking the second formula, the other formula wherein you take proprietary funds and total assets, then you'll have to take what? Proprietary funds in the numerator and total assets in the denominator. Followed? So alphabetically FPT, so F first, P later. In P and T, P first and T later. So accordingly the numerator and denominator. Okay. You'll say, sir, what is proprietary ratio if you have to write? As I've said, if you're taking fixed assets by proprietary funds, you'll say how much of the proprietary funds have been used for fixed assets. Correct? That is how we can write. Higher the ratio, better it is. Correct? That means more of the proprietary funds, more will be the comfort, lesser will be the risk, lesser will be the burden. Okay, sir. Now one more which is not there in your book but you can still write is total assets to debt ratio. Total assets to what? Debt ratio. Now you might have understood what are we going to write in the numerator? Total assets. And what will we write in the denominator? Obviously the debt, that is long term debt. Right. Total assets means what? Obviously fixed assets and current assets. Fixed assets and current assets is nothing but the total assets. Long term debt is debentures, that long term loan taken from the bank. So that is what. So now tell me, what is this about? Sir, how much of the long term debt has been used for total assets? That means if you have some fixed assets plus current assets, like we said in the above example, 140. So out of 140, if I say 80 is proprietary funds, that means 60 is long term debt. So I can write here, maybe 140 is total assets, 60 is long term debt. Right. This is total assets to debt ratio. So do you think more the long term debt, more will be the risk? Yes, sir. Now by now, so while we are asleep also we can answer this. In our dreams also we can answer this. That more the debt, more will be the risk. More the risk, more will be the burden. More will be the dependence on outsiders' funds. That's not good. Should not depend too much on outsiders' funds. That will be quite risky for you, right? Okay, sir. So this is how we have completed now the third set of ratios. First one was cash position ratio, second one was liquidity ratio or working capital ratios, third one was capital structure ratios. Now let's go for the fourth one. And fourth one is profitability ratios. Which ratios? Profitability ratios. After this we'll see turnover ratios and then some other ratios. Okay, right. Right. So let us talk about the first profitability ratio, which is return on investment or also called as return on capital employed. Return on investment is also called as ROI, correct? And return on capital employed, if you're using this term, then ROCE, right? This is how in short we can use return on investment or return on capital employed. Now before I get into this return on capital employed or return on investment, let's try to recall the P&L which we have discussed, the way we present the P&L in financial management. If you can recall that, we said sales minus cost of goods sold, right? Cost of goods sold will give us gross profit. From this gross profit, what will we deduct? We'll deduct the other operating expenses, so that we arrive at the operating profit, and we'll assume that to be EBIT That means we are assuming what? There are no non-operating items, correct? No non-operating item. Now from this EBIT or PBIT, we'll deduct what? Interest. After deducting that, we'll arrive at earnings before tax or profit before tax, EBT or PBT. Then from this we will deduct taxes, so that we arrive at earnings after tax. And from this, preference dividend, so that we arrive at earnings available for equity shareholders. And if we subtract equity dividend from this, then we get the retained earnings. We get what? Retained earnings. That is nothing but reserves and surplus, correct? This is how we said the P&L looks like here. So sales minus cost of goods sold gives us gross profit, minus the other operating expenses will give us operating profit. And assuming that there are no non-operating items, so that's where operating profit is same as EBIT, from which we'll subtract interest, so that we arrive at earnings before taxes. From this we'll deduct taxes, so that we arrive at earnings after taxes, and then preference dividend, so that we get earnings available for equity shareholders. And then equity dividend is subtracted, then we get retained earnings. Acha, in case this earnings available for equity shareholders, instead of subtracting equity dividend, if I divide this by number of equity shares, divide this by number of equity shares, then what do we get? We get earnings per share, which is in short EPS, correct? So instead of subtracting equity dividend, we can divide it by number of equity shares, so that we arrive at earnings per share. So sir, why are you discussing this now? Now see, we are discussing profitability ratios. So do you think we will take the help of gross profit, operating profit, or earnings after taxes? Do you think these profits we will be using in the various ratios which we are going to discuss now? Of course, yes, we are going to discuss. That's where I have written it once, so that we can take the help of it whenever required, right? Now coming to this return on investment, I hope you are aware that this is the most important ratio, right? This is the most important ratio. You'll say, sir, why like this? See, because it so happens that if we want to know the overall efficiency of the organization, it can be found out, or you can say we can find it out from this return on investment ratio. Okay, so most important ratio, as it can help us to judge the overall efficiency. Okay, and one more thing I would like to tell you here, that this particular ratio is actually a combination of various ratios, and that we will understand, that we will prove by way of DuPont chart, which is there in your book, as you could see as well. That we'll discuss later, sometime later. But what I'm trying to say is, this particular ROI, this particular return on investment, this particular ratio, okay, ROCE, is a combination of different ratios, multiple ratios. That is why also this is very important. Okay, this is most important ratio because of these two reasons. One, it's a combination of different ratios. Second one, as I said, it helps us to judge the overall efficiency of the company, judge the overall efficiency of the organization, right? How will that happen? So, or how will we prove this? So we said, or I am saying that we will take the help of DuPont control chart, okay, later, not now, and I will prove this. Okay, DuPont control chart. With the help of that, you will understand that this return on investment is a combination of various ratios, and it will help us to judge the overall efficiency. Okay, right, sir, fine. Now coming to this ROI, or maybe you can say ROCE, as I said, return on investment, return on investment. So return on, so return divided by what? Investment, right? Or we may say capital employed, because this itself is return on capital employed. So return on capital employed, so return in the numerator and capital employed in the denominator. So now the question comes that which particular return do we need to take? Which particular profit do we need to take? Now guys, please tell me, capital employed means what? Debt plus equity. What will we give to the debt providers? We'll say interest. What will we give to the shareholders, that is equity? We'll say, sir, dividend. So this interest and dividend is paid out of what? You'll say, sir, interest and dividend is paid out of EBIT. So does this mean now we'll have to take return means EBIT here? We'll have to take this return means nothing but operating profit, or you can say EBIT. The answer is yes. The capital employed. When you employ the capital into the business, you expect profit. Whether you are a financial creditor, whether you are a shareholder, you are employing some funds into the business, so you expect some profit or not? Yes. Profit from where? Operations or non-operating activities? Obviously operating activity. You have invested for operating activity, not for non-operating. Non-operating comes because there might be some surplus funds. So if someone is putting money, he is thinking about operations and then putting money. So one has to understand, when we say return here, which return do we need to take? Operating profit. And another common sense point, see, this non-operating profit, suppose we take non-operating profit also here. What would happen? If you want to compare, let's say our own performance with the previous year's performance, do you think it will be uniform, it will be correct? No, because last year there was no non-operating profit, let's say, and this year if you are adding that non-operating profit also, you are giving a wrong picture. So one has to understand carefully that you can't take non-operating profit, okay, because non-operating profit is there this year, next year it may not be there, right? Last 3 years it was not there, just for this year it is there. So if you're taking some figure odd man out here, and then if you want to compare, there's something called as intra-firm comparison, correct? Inter-firm comparison means you will compare your firm's performance with other firms. Intra-firm means you will compare your performance with your own performance, but of previous years, correct? So one has to understand properly here that we need to take the right figures, okay? So when someone invests the capital into the business, he expects operating profit, so please take operating profit. Secondly, if you take non-operating, what will happen is the comparison will be wrong. Even if you want to compare with, let's say, other firms, let's say you want to go for inter-firm comparison, right? There may not be non-operating income for them, but you have taken it here, so you are showing a higher picture, which is wrong. Getting it? So please understand that we will not take non-operating profit here. We'll take only what? Operating profit. And if you want to write EBIT also, it's fine, because when you're writing EBIT, that means we are assuming that there are no non-operating item. Clear? Right, sir. So that is how we get the numerator. Now denominator is what? Capital employed. Denominator was capital employed. But now one more thing here. See, the numerator is coming from P&L, correct? The numerator is coming from P&L, and denominator is coming from where? Balance sheet, because capital employed means what? Capital employed means debt and equity. So you will take that from balance sheet. So one figure is from P&L, other figure is from the balance sheet. Now the figures which are there in the P&L are for the year, am I right? Are for the year, whereas the figures which are there in the balance sheet is as at a particular date, as on a particular date, isn't it? It's not for the year, it's as on a particular date. So numerator has got a figure which is for the year, denominator has got a figure which is as on a particular date. That means in a way you're comparing oranges with apples, whereas you should compare oranges with oranges, apples with apples, isn't it? So that's where, my dear friends, what we will have to do here is we will take in the numerator operating profit, or maybe EBIT, whatever you want to write, okay? Better term would be operating profit, of course. So or EBIT divided by, we will take what? Average capital employed. We can't make profit, right? We can't change the profit as on a date, right? We cannot write that. Profit is for a particular period, but capital employed, when we say capital employed, that's on a particular date. We can change it to average capital employed. How do we arrive at average capital employed? Opening capital employed plus closing capital employed divided by 2. Correct? How do we get this average capital employed? Average capital employed is opening capital employed plus closing capital employed divided by 2. This is how we get the average. That means, let's say in the beginning the capital employed was 100, and let's say at the end capital employed is 50. That means during the period there is an increment in the capital employed to the tune of 50. Now you can't say 100 was only being used. You can't say 150 only was there in the year, correct? Because 150 is at the end. So we don't know exactly how much is the capital employed. That's why we are saying take on an average, how much was the capital employed during the year. So that is where we are saying take 125 then. So opening plus closing divided by 2. So 100 plus 150 divided by 2, as per this example, it will come to what? 125. Followed? What did I say? Return on investment is an important ratio, most important ratio, because it will help us judge the overall efficiency, right? It is a combination of various ratios, which we said we can prove also by way of DuPont control chart, which we'll do it later. Okay, later we'll discuss this chart later. Okay, next. Now, how do we get this return on investment or return on capital employed? So we said return on investment. The name itself can help you. Return on investment, so return divided by investment or capital employed. So question comes, which return we need to take, which profit we need to take. So see, someone is putting in funds as a debt provider, as a financial creditor, or as a shareholder. Obviously is investing for the business operations, for the purpose of business. So they'll expect profit also from that business, from the operations. That means operating profit they want, right? Or you can think it like this, that see, capital employed means debt plus equity. So debt means they want interest, equity means they want dividend. So this debt and equity, right? This debt and equity who gets interest and dividend is paid out of what? Paid out of EBIT, paid out of operating profit. That way also you can think, right? So that's where we have written operating profit or EBIT upon capital employed. So now we said why we are not taking non-operating profit. We are not taking non-operating profit for the simple reason that non-operating may be there, may not be there. Every year it may not be there. Every case it may not be there. So it will be wrong to take that and maybe say that the performance is good. Because if you add non-operating profit, that means you're trying to show, you're trying to make up, correct? Make up something. That is not right. So keep non-operating aside. Think about only operating, and then comparison also will be right. Comparing your own performance of the last year with this year's performance. Same way, comparing with other firms' performance also will be right. Otherwise, it will not be correct, right? And then we said that when we look at the numerator, we find that the numerator has got some figure from the P&L, which is for the year, whereas denominator has a figure which is coming from the balance sheet, which is as on a particular date. So now some figure is throughout the year, some figure is as on a date, which will be not right. So we'll have to make it uniform. But this possibility of making it uniform will be only if information is provided in the question. If information is not there relating to opening and closing figures, then we cannot calculate average. But then if information is provided, then of course we'll have to take. Okay. So if one variable from P&L, one variable from balance sheet, later on also, please remember, not just this for this formula, this ratio, but later on also, whenever one figure is from balance sheet, one figure is from P&L, okay, that means the two figures which you are taking are from two different statements, then take average. If information is there, if information not there, we can't help, but information there we should. So that's where we have written average capital employed. So we said we can take opening capital employed plus closing capital employed and divide it by 2, so that we get average capital employed. So now it is like throughout the year, on an average, this much was the capital employed. Throughout the year, you have done something to earn this much of profit, that is operating profit. So that is where we'll get it. Okay. How do we denote this particular return on investment? Obviously, we denote it in percentage always, isn't it? We denote it in what? Percentages. And we'll say higher the ratio, better it is. Right? Any profitability ratio, always will say higher the ratio, better it is, right? Better it is. Correct. Now Now let's go for the next one. Okay, this was the first one, ROI. Now let's talk about the second one, return on net worth. Okay, after return on capital employed, we are discussing return on net worth or return on equity, or return on shareholders funds, anything, right? So we want to know how much return has been generated for the shareholders. So see, now if we have to write the formula, we'll say return on equity, return on equity. So equity or net worth will be in the denominator, right? Now you might ask, sir, which return do we need to take here, right? Which return do we need to take here? Acha, what is equity? Shareholders funds. So for shareholders, what do we give? For shareholders, what do we give? Dividend. If preference shareholders, then we give preference dividend. If equity shareholders, we give equity dividend. So dividend is paid out of what? So dividend is paid out of EAT, correct? Dividend is paid out of what? EAT. So please understand, my dear friends, when we are taking this return, we will have to take which return? EAT, earnings after taxes divided by equity. Sir, again, shall we write equity or average equity? Because EAT is for the period, for the year, and equity means as on a particular date. If you have the information relating to opening and closing, then you shall take average equity. I am repeating again, when the two variables which you take are from different statements, then it is always better to take average if information is provided. Okay, so I am writing here for you one figure from balance sheet, another figure or other figure from P&L. If this is the case, in any ratio I am talking about, any ratio, if this is the case, then always take this balance sheet figure as, always go for average of this balance sheet figure, if obviously information is provided. If info is provided. If info is not provided, then how can you do it? Correct? Yes, sir. Okay, so I hope you have understood that net worth means shareholders fund. So we will pay shareholders the dividend, which will be dividend from the EAT. We'll have to pay off interest. We'll have to pay even taxes. Then the profits which are left will be for the shareholders. So that's where EAT upon equity is this return on equity or net worth. Okay. Percentage it is denoted, higher the ratio it is better. So those are some simple things which you know already. Okay. Now let me go for the next one. Return on equity shareholders funds. Return on what? Equity shareholders funds. So here you will say, sir, again we'll take return in the numerator, and return in the numerator, and then equity shareholders funds in the denominator. Okay, now question comes, what is this return? Which is this return we need to take? Do we need to take gross profit? No. Equity shareholders funds we are talking about. We're not talking about equity now. We're talking about equity shareholders funds. So they'll get equity dividend. Equity dividend out of what? Out of the earnings available for equity shareholders. Correct? See, EAT divided by, not divided, sorry, subtracted by, we are subtracting what? Preference dividend from it. So once we pay the preference dividend, whatever profits are there for whom? Equity shareholders. So this is earnings available for equity shareholders, right? So this is what is that particular profit which we will have to take for equity shareholders funds. So we'll say earnings available for equity shareholders divided by equity shareholders funds. And again you may ask me the same question, sir, shall we take average equity shareholders funds instead of taking just equity shareholders funds? If information is there, you should take. I'll not repeat that again and again, you might have understood by now. Okay, so when required I will talk about it, otherwise you can just assume that it is there. Okay, so return on equity shareholders funds means you'll take return divided by equity shareholders funds. So you're able to understand how much is the return generated for equity shareholders funds, and that's return is nothing but earnings available for equity shareholders. How do you arrive at this? As we said, EAT minus preference dividend. You'll say, sir, if preference dividend is not there, then obviously the EAT itself is earnings available for equity shareholders divided by equity shareholders funds. Acha, how do we get equity shareholders funds? Equity share capital plus reserves and surplus minus the fictitious assets. This is how we get equity shareholders funds. Denoted in percentage. Higher the ratio, better it is. All this we know. Correct? So we have discussed return on investment or return on capital employed. Secondly, we have discussed return on net worth or return on equity, whatever we want to call it as. Then third, we have talked about return on equity shareholders funds. Right, sir. Now let us talk about the next ratio. Okay, the next ratio, and I will name it as some other ratios. Okay, other profitability ratio or other ratios in this profitability function, in which we'll discuss first gross profit ratio. We'll discuss what? Gross profit ratio. Sir, very easy, है ना? Since childhood we are reading this. Gross profit ratio means gross profit upon sales. Upon what? Sales. In 200, if you don't write also, it's fine, because you'll denote it in percentage, so we know you'll multiply by 100. Right? But still, if you want me to write, I'll write it for you. As such, it's not required. As such, it is not required. So now, both the figures coming from P&L, so no need to do any average here, right? Gross profit ratio is simply gross profit upon sales. Now, denoted in percentage. Higher the ratio, better it is. So all these things you know. Let's not waste time here. Let's go to the next ratio. Net profit ratio, which is also called as operating profit ratio. Net profit ratio, which is also called as what? Operating profit ratio. So sir, what should we take here? We will take here operating profit, that is EBIT. Okay, that is EBIT, because we are assuming no non-operating items there. It is there, then we'll talk about it. Otherwise, please remember, operating profit is same as EBIT. It will be different only when there are non-operating items, as I've told you earlier also. Okay. Yeah, and I have told you what do we mean by operations, what do you mean by non-operating activities, operating activity that we have discussed. So I presume that you remember it. So net profit ratio means operating profit, that is EBIT, divided by what? Sales, of course. Sales in 200, denoted in percentage. Higher the ratio, better it is. Correct? Okay. Acha. There is another school of thought, meaning there is another formula for this, which is earning after taxes upon sales. Few people say, when we are saying net profit ratio, take net profit, and net profit means what? Pay off interest, pay off even taxes, and then the profit which is left, it's net profit. So take that. Why do you take operating profit? So that is another school of thought. So maybe they can take that as well. See, this is not something which is there in some law. Okay, and it's not that you have to take only that. It's up to us. So generally people take operating profit by sales, so we'll write operating profit by sales. But then we know that sometimes people may take EAT upon sales also, so we have written that as well. Sir, in the examination, what should we do? See the information. From the information, find out what do we have, and based on that, calculate it. Suppose in the information you have only EBIT and sales information, interest and taxes information not there. That means it's an indication to you that you should be using EBIT upon sales. Sir, if full information is there, even interest, taxes information there, then what should we take? Whichever one you want, you can take. If you have some time, then you write there. Other formula can be this also. Okay. So if you have time, then you can calculate both. If you don't have time, don't waste your time. Rather, just write one and say other one possible. Okay, other one possible. So you can write formula and leave. Don't calculate for that also. If you have time, I'm repeating again, if you have information, calculate both. But if you have no time, information there but time not there, then solve one. If you want, you can write the formula, the other formula, that's it, but don't solve it. Okay, right, sir. So net profit ratio, that is operating profit ratio. Now next one. So next one is sixth one, which is individual expense to sales ratio. Individual expense to sales ratio or group of expense to sales ratio. So this is something complementary to the profitability ratio, if you understand. This is something complementary to the profitability ratio. Individual expense to sales ratio. That means what? You'll say, sir, like material consumed, individual expense to sales into 100, you might say. Or you'll say, sir, wages by sales, that into 100. Or you may say, sir, factory overheads divided by sales. Correct? Or maybe if I talk about group of expenses ratio, you might say, sir, cost of goods sold by sales, cost of goods sold by sales into 100. This can be group of expense to sales ratio. Or let's say selling and distribution expenses upon sales into 100. Correct? Or maybe we can say administration expenses upon sales into 100. So this is how, maybe I can write here, etc. There can be different expenses which you might take individually and compare with sales, or group of expenses compared with sales. Sir, what will happen because of this? We'll get to know the percentage, right? We'll get to know the percentage of the cost in terms of sales. And when we know that, right, when we know that whether it is higher, lower, accordingly we can take remedial action. If it is higher, if cost percentage is higher in terms of sales, do you think measures can be taken, suitable measures can be taken to reduce the cost? Yes. So that's the idea, right? So I can say this is something complementary to profitability ratios, right? This individual expense to sales ratio, I can say, is complementary to what? To profitability ratios. Okay, next, second thing, as we said, these ratios can help the company to take remedial action, right? Whichever expense is higher, they can try to control that. Whichever group of expenses higher, right, when they compare, maybe compare with other firms or compare their own with their own performance in the previous period, they can understand whether it is higher, lower, and if it is higher, they can take always remedial action for it, right? That's the use of this particular ratio, right? Complementary to profitability ratio. So if you want, you can say, if cost ratio is higher, I can write like this also, cost ratio is higher, then profitability is lower. Correct? Profitability ratio or profitability is lower. Right, sir. So this was what? Individual expense to sales ratio. Now let's talk about one more here. Operating ratio. Okay, earlier was net profit ratio or net operating profit ratio. Now we're talking about operating ratio. So we're talking about operating cost. Okay, this operating ratio means we're talking about operating cost divided by sales. You'll say, sir, what is this operating cost? Obviously, cost of goods sold. The operating cost, the cost incurred for the business operations. So cost of goods sold plus other operating expense. That will give us operating cost. So operating cost divided by sales into 100 will give us operating ratio. Is this complementary to the profitability ratio? Yes, of course. This is complementary to the profitability ratio. Because see, when we talk about sales, that's nothing but operating income, operational income, yes or no? Income from operations is nothing but sales. This sales will be comprising of two elements, cost and profit, isn't it? Cost and profit. So when you are comparing cost, which cost you are talking about? Operating cost. When you are talking about profit, which profit you are talking about? Operating profit. So operating cost to sales is operating ratio. Operating profit to sales is operating profit ratio. Are you getting it? When you are talking about operating cost to sales, that means you are talking about operating ratio. And when you are talking about operating profit upon sales, okay, this is operating profit ratio. Am I clear? All of you are able to understand? Operating cost to sales is operating ratio. Operating profit to operating income, that is sales, is operating profit ratio. Higher the ratio, better it is. Operating ratio cannot be higher. My dear friends, please understand, whenever we talk about cost ratios should be always what? Lower the better. Lower the better, not higher. Profitability ratios we can say higher the better, but not for cost ratios. Okay, so okay, now guys, you will have to tell me one thing. When we talk about this sales, when we are talking about the sales, which we have taken here, gross profit upon sales, right, net profit upon sales, when we are talking about this, is it sales without deducting sales returns? No sir, we will deduct sales returns. If there are any sales return, we'll have to deduct it. Acha, fine. Now what about taxes like GST? So if this sales is including GST, we'll have to deduct that GST also. We'll have to deduct the taxes also. Yes, because see, no one earns profit on tax. Correct? That is collected and paid to the government. We're just acting as a mediator. Collect, pay. So please understand, if at all there is some tax like GST, okay, GST or taxes, that we'll have to deduct and then take sales. So net sales we will take. Will not leave sales returns. We're not going to just ignore GST. No, we are going to deduct that if it is added. You say no sir, it's not added only. Fine, then you don't have to do any adjustment there. Okay, so kindly understand, when you're taking gross profit, you have to take gross profit upon sales, okay, for gross profit ratio, and that sales is net of sales returns and net of taxes. Same way when you're talking about operating profit, also the same thing. Okay, so this you can keep in mind. Same way you can say sir, individual expenses and all, yes, there also it is possible. Okay, so now we can say we have completed even profitability ratios, and now we can go for which one? The next set, right? Fifth type of ratios, which is turnover ratios, Okay, let's try to understand turnover ratios. We have seen cash position ratios, wherein we have absolute cash ratio. We have got cash interval measure. We have got cash to total assets ratio, right? Then we have talked about liquidity ratio or working capital ratios, which is short term solvency ratio, that is current ratio, and liquid ratio, that is quick ratio. Next, we have talked about the capital structure ratios, where we have discussed equity ratio, debt equity ratio, capital gearing ratio, then proprietary ratio, right? Long term debt to value ratio. Like that, we have discussed few of the ratios there, capital structure ratios. Then we have talked about the profitability ratio just now. So return on investment, then return on net worth, then return on equity shareholders funds, then gross profit ratio, net profit ratio or operating profit ratio, then the individual expense to sales ratio or group of expense to sales ratio. Also we have talked about the operating ratio, that is operating cost upon sales, right? This way we have discussed. So guys, you'll have to just keep revising it so that you remember it, and when we solve the questions, no, it is easier for us. If you don't remember, solving questions will be difficult, and it's not that difficult that you cannot remember it, right? Now we are into the next set of ratios, which is turnover ratios. Turnover ratios. Right. So let us talk about the first turnover ratio which we have is capital turnover ratios. Capital turnover ratio. Okay. In short, I'll call it as CTR. Acha, what does this turnover ratios give us, or what is it for? So if you understand, this turnover ratio help us study sales, right? No, this turnover ratio help us understand or study the efficiency. Help us know the efficiency. So don't think just because the name is turnover ratios that means we are here to study sales. No, we are here to know the efficiency. We are here to find out the efficiency of the company. Okay, right. So when we are talking about this, are we talking about sales? Turnover means, are we talking about sales? Yes, predominantly it is about sales. Sir, why are you saying predominantly? Why not always? You will get to know when we solve the ratios or when we discuss the ratios. Okay, so have patience till then. Right. Let us come to the first ratio, capital turnover ratio. So now, sir, there should be capital, there should be turnover. For sure, we know capital and turnover. So we are talking about capital employed and turnover. Which turnover? Sales. So which one should come in numerator? Which one should come in denominator? Now, please understand something here. There's something called as output and there's something called as input. Correct? When we have the figures here, when we have two variables here which are having this relationship of output and input, then always remember output should be in the numerator and input should be in the denominator. Okay, output in the numerator and input in the denominator. Please remember this simple funda. So when we have two variables which has got this output and input relationship, please find out what is input and what is output. Now in this particular ratio, like capital turnover ratio, capital employed is one variable and turnover, that is sales, is another ratio. So when you employ the capital, then that is where you will generate sales, no? So input is capital employed and output is what? Sales. So my dear friends, please understand, sales will come in the numerator and capital employed will come in the denominator. Now you might say, sir, sales come from P&L and capital employed comes from balance sheet. So two different statements. So you know, average can be taken if information is provided. If information not provided, then obviously whatever information there, that closing only will have to take. But if information is provided with respect to opening capital employed and closing capital employed, then you should take the average capital employed. Right guys, have you followed this? Okay. Now tell me, higher the ratio better it is or lower the ratio better it is? Obviously you say, sir, higher ratio is always better. Correct? So higher the ratio, that means higher the sales, better it is. Right? Better is the efficiency. Better is the efficiency. So there's, as such, there's no standard 20%, 30%, nothing of that sort. Okay, 100% and all. But higher is always better. Right? Higher shows more and more efficiency is there. So this was the first turnover ratio which we have taken. Now let's go for the next one. What's the next one? Fixed assets turnover ratio. Fixed assets turnover ratio. In short, I'll call it as FTR. Okay, fixed assets turnover ratio. Now again, in this, if you understand, what is happening is there are two variables, fixed assets and turnover, which means sales will take, and those two variables which we have share an input and output relationship. Sales is output and fixed assets is input, isn't it? Correct. So we'll have to write sales in the numerator and denominator will be writing fixed assets. Then you'll say, sir, this fixed assets, again, shall we take average fixed assets? Yes, if information is provided, because sales which is in the numerator is coming from P&L, so that's for a period. So fixed assets also should be for a period, and that's where it should be average fixed assets provided information is there with you. Okay. Okay, sir. Higher the ratio, better it is, or lower the ratio, better it is? Obviously higher. More the sales, that shows more is the efficiency, or more efficiently you have used the fixed assets, correct? So I can write here, higher the ratio implies efficiently the fixed assets were used, right? Okay. Now with this only we come across, or we can talk about working capital turnover ratio. One more ratio which can be talked about here is working capital turnover ratio. Let me call it as WTR. Okay. So when I am talking about working capital turnover ratio, now again sales has to be in the numerator and working capital has to be in the denominator, correct? You say, sir, again shall we take average working capital? Yes, if information provided, you should take. Higher the ratio, better it is? Yes, higher the ratio, that means more efficiently you have used the working capital, right? So higher ratio is always better. Higher ratio is preferred, is better. Sir, can we say this working capital turnover ratio and fixed assets turnover ratio are complementary to each other? Yes, of course, because if you know fixed assets turnover ratio, then obviously you know working capital turnover ratio also. If fixed assets turnover ratio is, let's say, 75%, that means working capital turnover ratio is 25%. That's what will happen, correct? Because you know total assets comprise of fixed assets and current assets, right? Or capital employed, when I talk about fixed assets and working capital we take. So that's what is happening here with respect to the capital employed into fixed assets, capital employed into working capital. So that capital employed, right, because we took capital employed, please see. So that's where we have to take fixed assets and working capital, not current assets. So we are just trying to break this capital turnover ratio into two. If you understand, we are breaking this capital turnover ratio into two. One, sales fixed assets turnover ratio, and another one, working capital turnover ratio. Okay. Yes, sir. Okay. Let's go for the next one. Inventory turnover ratio. What? Inventory turnover ratio. Now you will say, sir, inventory is of finished goods, inventory is that of even raw material, inventory is that of even WIP. So which one are we talking about? Normally when nothing is specified, please presume that it is of finished goods. Okay, when nothing is specified, please understand, generally it means what? Finished goods. Generally inventory denotes what? Inventory of finished goods. If they themselves mention raw material, then that is where we'll have to take raw material. Okay, fine, sir. Now so this we'll say in short ITR. Okay, inventory turnover ratio. So now which are those two variables which we have here? Sir, one is inventory, another one is turnover. Inventory turnover ratio, no? So inventory and turnover. Okay, sir. So now shall we take inventory in the numerator or in the denominator is the question. So again just think whether they have input output relationship. You'll say yes, sir. Inventory and sales will obviously have this finished goods you're manufacturing or you're purchasing for selling purpose, right? So this finished goods inventory which you have is an input and sales is nothing but the output. So I'll have to write here what? Sales divided by inventory. Divided by what? Inventory. Now the question comes, sales is for a period. So obviously this should be what? This inventory should be average inventory, because you cannot take it as on a particular date. You will have to take it for the period. So average inventory. And how do we calculate average inventory? Opening inventory plus closing inventory divided by 2, right? Okay, sir. So inventory, I'll change it to average inventory. Secondly, inventory is at cost price. Inventory is valued at what? Cost. Whereas when I am talking about the numerator where we have sales, that means it is at selling price. So one figure is at selling price, another figure is at cost price. Do you think the comparison makes sense? No. So please understand, that's where we will change it to what? Cost of goods sold. Cost of goods sold. Are you getting it? How do you get this cost of goods sold? Come on guys, how do you get this cost of goods sold? Sir, one way is sales minus GP. Okay, one way to calculate is sales minus GP. The other one is what? Sir, opening stock we can take plus purchases we can take, because this much, the opening stock means this much stock was there, plus additionally we have purchased more. Okay, plus incidental expenses are there. Okay, so let's say opening stock is worth 200 rupees. Purchases and incidental expenses comes out to, let's say, 500. So 200 plus 700, 500 is 700 rupees worth of stock we have during the year. But then when we see at the end, we find only 400, only 300 is there. So what happened to the remaining 400? Sold, right? So minus, if I say closing stock, as I said in this example, that maybe we have 200 rupees worth of opening stock, purchase and incidental expenses comes to 500, so totally 700. Now when we see at the end, you find closing stock of what? 300. So what happened to the remaining 400 worth of stock? Sold, right? And 400 is at cost price, so that is cost of goods sold. Am I right, guys? Right? So this can help us understand 400 is what? Cost of goods sold. The goods which are sold are worth how much? The cost of that goods are worth how much? 400 rupees. This is another way of calculating cost of goods sold. Anyways, all of us know this, but my idea was just to remind this. Okay, so inventory turnover ratio we can calculate using what? Sales and inventory. Sales will have to take it as cost of goods sold, not sales, because selling price, sales is at selling price, but whereas inventory is at cost price, so better we take cost of goods sold. So cost of goods sold by average inventory. So ultimately I can write inventory turnover ratio as what? Cost of goods sold divided by average inventory. Okay, sir. Now let me take some example. Let's say cost of goods sold is some 8 lakh rupees and average inventory is, let's say, 2 lakh rupees. So you get what? 4. So this is your ITR, and it is 4 times. Okay, 4 times. We always denote this in times. So 4 times is the inventory turnover ratio. So what does this mean? This means that you were having the stock and you were able to rotate it 4 times. You were keeping some stock, selling it. Again keeping some stock, selling it. Keeping some stock, selling it. So this is how you could turn your stock 4 times, okay, in a year. That means on an average, how much time did you keep this stock with you? How much time did you keep the stock? On an average, how much time did you keep the stock with you, so that we can say that this much was the time for which you could hold your inventory and then sell it, right? So that is where the concept of stock holding period comes. Okay, stock holding period. How do we get that stock holding period? How many months are there in a year? 12 months. So 12 months divided by 4 if I do, I'll get what? 3 months. I'll get what? 3 months. So that means we are having the stock for 3 months, or we are taking 3 months of time to sell our stock. Now you tell me, instead of 4 times, if it is 6 times, then what will happen to stock holding period? It will come down. And if it is coming down, is it good or bad? Sir, it is good. See, what I'm saying is, instead of this 4 times, let's say it is 6 times. So if it is 6 times, that means 12 by 6 you'll get 2 months. So instead of 3 months, if you're able to sell your stock within, 2 months, is it good or bad? Good. So when it comes to this number of times, when you are talking about inventory turnover ratio, okay, turnover ratio, higher the better, higher the better. And when we are talking about stock holding period, please understand, we'll say here lower the better, lower the better. Okay. Now, one thing which you have to note here, we have calculated first inventory turnover ratio. Thereafter, I have calculated stock holding period. If I wanted the answer in months, so thereby I have written 12 months. 12 months divided by that inventory turnover ratio, which is 4. So we got 3 months, isn't it? That means to calculate this way, first we'll have to calculate ITR. Then only we can come to this stock holding period. Okay, stock holding, SHP, let's say, stock holding period. Sir, is there any other way out? Yes, why not? There's another way out of calculating SHP. What is this another way out? You can always say, what did we do? 12 months we did, right? So 12 months by 4. 4, how did you get? 4, you get it by cost of goods sold by the average inventory, correct? And let me put it this way, 12 months by 1. Stock holding, I'm going by this example. So 12 months, so 12 months divided by 1. Stock holding period, I said 12 months is the total number of months in a year, divided by inventory turnover ratio. So I'm doing it this way, 12 months divided by 1. I'm writing 12 months as 12 divided by 1. I don't think there should be a problem for that. And then how did we arrive at 4? So we said cost of goods sold. 4 is nothing but inventory turnover ratio. So inventory turnover ratio is cost of goods sold by average inventory. Now you might have learned in your mathematics something called as this A by B divided by what do you say, C by D can be written as A by B into D by C, or you might have also read that this can be written as D by B by C by A. A by B upon C by D can be written as A by B into D by C, one. Second possibility, D by B upon C by A. So what does that mean? We have interchanged this D and A. This can be done or not? Yes, sir. So that's what I am going to do now. Average inventory, in the numerator I am writing average inventory, upon 1 means average inventory only. So I am not writing upon 1 now, divided by cost of goods sold by 12 months. So this means we can say average inventory upon average daily, no, not daily, because it is in months, no? So we'll have to write months, average monthly, right? What do we need to write? Average monthly cost of goods sold. This is how we can get what? Stock holding period. So if you have average inventory and you know cost of goods sold, take out average monthly cost of goods sold and then take these two and compare, you will get directly stock holding period. In case, sir, no sir, I have calculated for ITR, then I want to calculate stock holding period, the above one will work, okay? This is alternate way I am talking about for calculating stock holding period. That you can take average inventory upon average monthly cost of goods sold. Instead of monthly, we can also take daily or weekly, it's up to you. If you're taking daily, then you'll have to divide by 365 or 360 days, whatever, okay? And weekly means by 52, you'll have to divide by 52. This is how you can do. Sir, but if I don't remember this, okay. So let me tell you mathematical way. See, we took the example here. $8 lakh is the cost of goods sold, correct? 8 lakh is the cost of goods sold for what? 12 months. And how much is the average inventory? 2 lakhs. So 2 lakhs is for how much? 8 lakhs is for 12 months. So for how much, how many months do we have this inventory worth 2 lakhs for? So cross multiplication rule, as you know. So you'll say, sir, 2 lakhs into 12, right? Cross multiplication now, divided by 8 lakhs. So what answer will you get? 3, no? 12 into 2, 24. 24 divided by 8. Lakhs anyways get cancelled. So 24 divided by 8 is 3. 3 what? 3 months. So this is how we can get stock holding period. This is another way, mathematical way. Okay, I am repeating this again. Please see. Inventory turnover ratio means it's about what do you say? How many times in a year you're able to generate, or how many times in a year you're able to convert your inventory into sales. Okay. So we have taken the formula as sales upon inventory, correct? On what basis? You know, input and output basis. Output is sales and input is inventory. Then we said this sales is at selling price and inventory is at cost price. So obviously sales have to be changed to cost. So that's where cost of goods sold we have taken. Then we said inventory is as at a date, particular date, which is not correct because sales is for a particular period. So we'll take average inventory here also. So that's how we got the formula of what? ITR as what? Cost of goods sold upon average inventory, correct? Okay, sir, correct. Then we said this is giving us number of times. 4 times is the inventory turnover ratio, which will not help us to analyze things properly. So that's where better to convert this into what? Stock holding period, inventory holding period. So how do we do that? So we said 12 months is the number of months in a year, divide by 4, because this 4 times in a year. So 12 months divided by 4, you do 3 months, correct? Or if you want to take the answer in number of days, then 365 divided by 4, or weeks, then 52 divided by 4. Accordingly, you will get the answer in number of days or number of weeks. So up to you. Anyways, so how do we read this stock holding period? If stock holding period we get 3 months, that means 3 months is the time taken to convert that inventory into sales. So I have asked this question that instead of 3 months, if it is 2 months, is it good or bad? Sir, good, because that means you are taking lesser time to convert your stock into sales. So obviously it's good. So lower the better. Stock holding period always lower the better, whereas the inventory turnover ratio is higher the better. More the number of times, that is where stock holding period will come lesser, correct? Then we said if this is the way we calculate stock holding period, then we have to depend upon ITR. First calculate ITR, then stock holding period. So if you don't want to do that, then another formula which is there is what? Stock holding period. Another formula is what? This one, right? Average inventory upon average daily or monthly or weekly cost of goods sold. How did we arrive at that? So I've shown you that also, that this stock holding period 12 months upon ITR. How do we get ITR? This 4 months, 4 is what? 4 is nothing but ITR, no? So how did we get ITR? Cost of goods sold by average inventory. So the way I have written here is 12 months upon 1 divided by cost of goods sold by average inventory. And then I have interchanged that average inventory with 12 months. So as you could see, average inventory has gone in the numerator. So average inventory upon 1, which is average inventory. In the denominator, cost of goods sold by 12 months. That means average daily cost of goods sold or monthly cost of goods sold, right? 12 months. So monthly I have to say. So this is how we arrived at average inventory by average monthly cost of goods sold, which can be changed to even daily or weekly depending upon you are taking 12, 365 or 52. Correct? This was directly. Now if you want to use this, then there is no need to calculate ITR. ITR not required. Without ITR you can directly go into this. Then I said if you want to calculate stock holding period, there's another way, mathematical way, simple way. Don't bother about formula. 8 lakhs is the cost of goods sold for 12 months. Average inventory is worth 2 lakhs. So how much is that? I mean, for how much period you have that inventory for? So we said cross multiplication rule. So 2 lakhs into 12 divided by 8 lakhs, so 3 months. So that means we are holding the stock for 3 months and converting into stock. That is 3 months is the time taken to convert that stock into sales. Is it good or bad? So we said lower, okay, lower the ratio, that means lower the time frame, better it is. Higher will not be better. More and more time you take, that's not good. That shows inefficiency. Lesser time if you're taking, that shows efficiency. Right, my dear friends? So we have talked about inventory holding period, inventory turnover ratio, in which not just turnover ratio we have calculated, but also inventory holding period we have calculated. And as we said, generally when nothing is mentioned, that means it is for finished goods. Now let's talk about raw material. Okay, inventory turnover ratio for what? Raw material. Now, so sir, again inventory turnover. So turnover means sales we should take. Do we buy raw material for the purpose of selling? No, we buy raw material for the purpose of consuming. So please understand, here I'll have to write what? Raw material consumption in the numerator, because this is the output, right? We are consuming it. And then denominator we should write what? The inventory of what? Obviously raw material. And again you will say, sir, average inventory we need to take here. So raw material consumption by average inventory, right? And if you say, sir, what about stock holding period for raw material, for raw materials, then I'll say the same thing. Inventory turnover, I'm sorry, 12 months, if you want the answer in months, divided by inventory turnover ratio. 12 months or 365 days or 52 weeks, whatever, correct? You can take and divide by ITR. This is how you can get. No, sir, we don't want to calculate this way. Then how do you get that? See, here we have written already. We said average inventory of what? Raw material divided by average daily or monthly or weekly raw material consumption. Raw material consumption, correct? This is another way, or mathematical way anyways is there, where you don't have to buy hard this, you just need to think about how much is the raw material consumption for the year, okay, and how much is the average inventory of raw material, cross multiply that way also you can get stock holding period. Turnover ratio means higher the better, and holding period means lower the better, correct? I can write this, I will write turnover ratio higher the better, right? In terms of number of times, higher the better. Whereas holding period, when I am talking about holding period, then we'll say lower the better, right? Lower the better. Okay, sir. So we have discussed capital turnover ratio, fixed assets turnover ratio, working capital turnover ratio. Then we have discussed inventory turnover ratio. In inventory turnover ratio, we have talked about finished goods. We have talked about even raw material. Correct? Yes, sir. Now we will have to check debtors. We'll have to discuss debtors turnover ratio, creditors turnover ratio as well, so that we can say turnover ratios are over. Okay, the discussion on turnover ratios over. And then after that we can take DuPont control chart also, because that is required. You'll understand why that is required. Profitability ratio and turnover ratios, the combination of that is actually DuPont control chart. So that we'll discuss. And then we can say yes, turnover ratios are over. And then after this, some other ratios, miscellaneous types of ratios are also there, that we will discuss. So in the next session, we'll be able to complete our discussion on ratios. And with that, we'll be good to start with questions. We'll be good to start some problems. Okay, I'll not say problems because it looks like a negative term. I'll always say question number, questions for which we have solutions. Okay, yes. So thank you so much. God bless you all. Please revise these ratios so that when you come to the next video, next class, you'll be able to understand that better, isn't it? And as I said, we'll be able to solve the questions also in our next session, maybe, correct, after discussing the ratios. So thank you, take care, right? God bless you all. Bye bye. Yes.